how to have the best countermeasures, how to deliver them, how to have not just the thing to give out, but the roads to do it, the metaphorical roads to do it into communities that may be distrustful, and you really need a strong public health system to do that. So it's really important to be thinking about what actually will be the next pandemic and preparing, but also these universal protections.
All right, so appreciate the time that we've had with you. Dr. Joshua Sharfstein, he's Vice Dean for Public Health Practice and Community Engagement at Johns Hopkins Bloomberg School of Public Health, as you know, supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies, joining us on the phone from Baltimore.
Such an important story that we're definitely going to continue to be talking about as the virus continues to mutate. But first off, we are going to quickly get a check on the latest world and national news with Nancy Lyons in the Bloomberg 99.1 newsroom in D.C. Hey, Nance.
Thanks, Madison. Well, a Los Angeles judge has sentenced Harvey Weinstein to 16 years in prison after a jury convicted him of the 2013 rape and sexual assault of an Italian actor and model. The sentence comes on top of the more than 20 years he received for a similar conviction in New York. Secretary of State Antony Blinken says he's hopeful China will not help arm Russia in its invasion of Ukraine. He says that's the last thing Vladimir Putin needs is a wider war with NATO. Chinese officials have been meeting with Putin this week, promising more trade and offering a plan for ending the war.
The Chinese are anxious not to jeopardize their economic recovery, Leland Miller, chief executive of China Beige Book International, said in a Bloomberg interview.
You're going to see a real recovery because businesses will get back at it. They didn't want to invest. They didn't want to borrow. They didn't want to hire last year. Well, now they're going to do some of that, and there will be revenge consumer spending as well. You're bouncing off terrible numbers for 2022.
President Biden has acted to crimp China's technological surge, Miller noted, and any decision to supply Russia with weapons would bring down crippling sanctions. In Washington, Irv Chapman, Bloomberg Radio.
With President Biden back from a surprise trip to Ukraine, a new poll indicates he is gaining more support. Bloomberg's Joe Matthew has results of an NPR PBS Marist poll that was conducted last week.
Overall approval at 46%, 49% among registered voters, which is a more important metric that we follow, the highest in a year and up from a bottom of about 36% last July.
Bloomberg's Joe Matthew says support for former President Donald Trump, though, has fallen. 54% now feel the party would be better off with another name at the top of the ticket. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. This is Bloomberg.
events, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash. It's 2:41 on Wall Street. Stocks higher across the board. We check the markets all day long at Bloomberg. I'm Charlie Pellet. S&P right now higher by 20 points, a gain of 0.5%. A lot of volatility in today's trading as traders continue to weigh whether prospects for a soft landing are still on the table amid the Fed's most aggressive tightening campaign in a generation. So the S&P up by 0.5%. The Dow's up 66, higher by just about 0.2%. NASDAQ up 82, a gain of 0.7%. The 10-year yield right now 3.86%, with the 2-year at 4.68%. Spot gold down $2 the ounce to $18.23. West Texas Intermediate crude up 2%, $75.40 for a barrel of WTI. Well, as for the interest rate outlook and the Fed, Julia Coronado is the president and founder of Macro Policy Perspectives, and she was interviewed this morning on Bloomberg Surveillance.
The Fed is still tightening policy, and if anything, the incoming data have added a hike into the baseline probably for both the market and the Fed. So that still means that there's a risk that they go too far. They have slowed down, so we've got a better shot at striking the right balance. But they're still, very focused on not letting inflation become entrenched.
And again, we've got the 10-year right now at 3.86%. Lucid Group plunged after the maker of electric vehicles posted worse than expected results. Lucid down 13.6%. And Lordstown Motors, another EV maker, has paused production and customer deliveries to address performance and quality issues with certain components on its Endurance electric truck. Today, we've got shares of Lordstown, which uses the ticker RIDE, RIDE, down 10.6%. Recapping stocks higher, S&P up 0.5, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You are listening and watching Bloomberg Business Week. So remember when it seemed like all of Wall Street firms and bigwigs in finance were all talking about fintech and innovation and disruption in the financial industry and paying up big time for fintech startups and the like? Well, they were, and then 2022 happened, which leads us to a Bloomberg Business Week story you can find online at bloomberg.com/businessweek, and of course on the Bloomberg terminal.
Yeah, it's such an interesting story, Carol, and we are going to talk about it with Bloomberg News consumer finance reporter Paige Smith in our Bloomberg 99.1 studio in Washington, D.C. Paige, thank you so much for being here. I mean, fintech was like the cool guy, right? Can you start off by just setting the scene for us? How much love were these companies getting financially?
You're exactly right. Fintech was definitely the cool guy on the street. And I mean, the funding levels really reflected that. I mean, in 2019, I think the funding level reached almost $140 billion. And to put that into perspective, that was something like almost 3 times the level of funding in 2020. So just exorbitant amount of cash going towards these deals. And, one analyst described it to me as sort of a balloon that just kept inflating, but is now deflated. And I would say that it is certainly deflated at this point in time.
A deflator more than a pop, it sounds like. Paige, can you tell us what exactly happened there and what that big adjustment has looked like?
Definitely. So I think that at this point in time, we just have a number of big players who were operating in this space just admitting that they've sort of paid too much. So you have insurance giants like Prudential sort of saying that they're switching gears and changing their strategies after acquiring the company Assurance IQ in 2019 for $2.35 billion. And I think part of this is just that a lot of that funding money dried up as a bear market took hold. And, there are a number of other examples that kind of point to this, these sort of precipitous drop in valuations of fintech. You have, sort of an outlier, but JP Morgan acquired the college planning website Frank for $175 million in 2021. And I mean, that has really turned out to be more than just a disappointing acquisition. The bank actually has gone as far to allege it was a victim of fraud. So you just have sort of this, certainly a tide change. And I think just to kind of set the plate though and go back, set the table rather, and go back to where we were in 2021 and during the period of the pandemic, where there was just this frothiness of the market. You know, a lot of big banks and other Wall Street entities were really looking over their shoulder, sort of fearful that you would have this, you know, these fintech upstarts eating into their customer bases, and that's where a lot of this a lot of this came from. But again, as that analyst said, I think the balloon has certainly deflated, not popped, but definitely deflated.
So I want to go back to JP Morgan Chase. I love your story. We love your story. And you talk about JP Morgan buying Frank, $170 million. And Jamie Dimon, who is never, you know, afraid to kind of say how he feels, has called that deal a huge mistake. So very clear about what he thought about it. That having said that, and I'm glad, Paige, that you brought up the pandemic, because to be fair, I'm wondering how the pandemic kind of distorted some of the gains and maybe ultimate losses when it comes to fintech, because it does feel like there was a fair amount of uptick, right? During the pandemic, these guys were on fire. We were all at home doing things, certainly everything and anything virtually, if you will, or online. So how did the pandemic kind of distort things and make money so cheap that you could kind of do anything with it?
I think you kind of hit on some of the primary points there, which is there were a lot of people staying at home. They had a lot of cash on hand, and they were sitting on their couches and online a lot more than they may be, you know, than you and I are today. So I think that really distorted things. And we've also seen that with other, you know, tech entities. You've seen Amazon and Netflix and Meta sort of have similar challenges. So I think there was definitely some distortion that happened. And, you know, while business is better now in some regards, and things have opened up, these investments maybe just didn't really live up to the sort of fervid expectations, I suppose, of both the acquirers and a number of investors in this space.
Well, and Paige, it makes me think about, okay, there was a pre-pandemic life, there was pandemic life with all of its, you know, distortions, the good and the bad, and then there's post-pandemic life, which we are still figuring out. So something like Stripe, right? Their volume growth is down substantially, but nonetheless, it's still a viable business. Is that a fair way to describe it, or no?
Most definitely, and there was some news today, for example, about you know, Goldman Sachs being involved in Stripe, involved with fundraising for Stripe in some regard. So I think that there are definitely, you know, I had one venture capital expert weigh in and kind of say, you know, don't discount fintech entirely yet. In fact, there actually might be some good deals to be had out there today. So it's not as if fintech is going away entirely. It's just that these sort of sky-high valuations maybe have sort of come down to earth a little bit.
Right, like at the end of the story, you say it doesn't mean that fintech is over, according to one of your sources. Paige, help us be smarter about fintech heading into the rest of 2023. What does the outlook look like?
You know, again, that same expert actually said, like I mentioned, that it actually might be a good time for folks to look at fintech if you're sort of, if it matches up with your line of business and there's something that you sort of had your eye on and you're a Wall Street giant with, you know, some cash to burn. Maybe going after fintech right now might be a better opportunity. There might be a better opportunity to do that as opposed to during the pandemic and during 2021 when we saw that just exorbitant amount of funding going towards these fintechs. There might be better deals out there today.
Yeah, because no doubt about it, we're all increasingly doing everything, you know, online, cashless society. I don't know the last time that I've used cash. And like, so I just think, you know, the innovation disruption makes sense, but like, you know, very cheap money can make for some maybe not smart developments, if you will, in a space.
Exactly.
Paige, what a smart story. Paige Smith, thank you so much. Consumer finance reporter at Bloomberg News, joining us from our 99.1 studio in Washington, D.C. You know, when there is cheap money, you get a lot of money thrown at ideas, and not all of them are going to ultimately play out.
Right, when the cash is free, you might as well just see how it goes, I feel like, right?
Yeah, exactly. And the stronger ones kind of rise to the top, which is ultimately what we're seeing. Yeah. Speaking of that, we've definitely come off our lows on the equity markets. We've got green across the screen. S&P up about 0.5%. Dow Jones Industrial Average, slight gain, up 0.2%. NASDAQ up about 0.2%. Bloomberg Business Week, Carol Master, Maddie Mills, and this is Bloomberg Radio.
Be sure to catch our
Your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. NVIDIA shares surging now by 14% after giving a bullish revenue outlook for the current quarter, suggesting that a push into artificial intelligence processors is helping offset sluggish demand for personal computer chips. Wayfair shares are plunging the most in 9 months after the company reported a worse-than-expected loss, along with a 19% drop in active customers, upending a year-to-date stock rally. Wayfair right now is down by 26.2%. Bath and Body Works has announced a full-year profit guidance that is below analyst expectations, despite a better-than-expected fourth quarter. And with more, here's Bloomberg's Denise Pellegrini.
Charlie, this outlook comes just a day after news of a looming proxy fight with Daniel Loeb's Third Point. The fragrance and soap seller expects adjusted earnings per share of $2.50 to $3 a share. That is below the $3.71 a share Bloomberg consensus. And fourth quarter adjusted EPS and sales did beat expectations. And the company also announcing it has hired advisors to help with a margin expansion and expense reduction strategy. The goal, $200 million in cost savings through 2024, Charlie.
And we do have shares of Bed and Bath Body Works up now by just about 3%. The retailer Dollar General tumbled after warning it would miss its fourth quarter financial forecast, in part of that because of that big winter storm in December. Dollar General down now by 4.5%. Those are the company stories we're following this hour, and this is Bloomberg.
This is Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
All right, we've got more Business Week to come, but first up, we've got to get you a check on the latest world and national news with Nancy Lyons in the Bloomberg 99.1 newsroom in Washington, D.C. Hey, Nance.
Madison, Hollywood producer Harvey Weinstein has received a sentence of 16 years in prison for sexually assaulting an Italian actress and model. The judge issued rejecting a motion by Weinstein's attorneys for a new trial. Today's sentence is on top of the more than 20 years he received for a similar conviction in New York. Singer R. Kelly was sentenced in a Chicago federal court today to 20 years in prison for child pornography and enticement of minors. This sentence only adds a year to his prison time, as Kelly will reportedly serve 19 years concurrently with his New York prison sentence. Alec Murdaugh, the prominent South Carolina attorney on trial for murdering his wife and son, has been testifying in his own defense today. He says he did not kill them, but he did admit he lied when he told authorities he was not at their dog kennels just minutes before the shootings, despite being heard on a video with his son. Jim Griffin is his attorney.
Alec, why did you lie to Agent Owen, Agent Croft, and Deputy Rutland about the last time you saw Maggie and Paul?
As my addiction evolved over time, I would get in these situations or circumstances where I would get paranoid.
Murdaugh faces 30 years if convicted. The National Transportation Safety Board is out with a preliminary report on the cause of a toxic train derailment in East Palestine, Ohio. Republican Congressman Bill Johnson serves that district.
All we know right now is the suspect is a failed bearing housing unit on an axle. Bearings fail for various reasons, but they are digging in deep to the sensors that alerted the train crew, the engineers, that there was a problem.
Congressman Johnson tells Bloomberg they'll keep testing the air and water until local residents feel satisfied. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Back to you, Madison and Carol.
All right, Nance, thank you so much. Bloomberg Business Week brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds. The sacrifices you made keeping your employees on payroll during the pandemic are not forgotten. Check the potential refund your small to medium-sized business may be eligible to receive through the Employee Retention Credit with no upfront costs. Learn more, just head to getrefunds.com.
And as we have been talking about all month, February is Black History Month. Every day we are celebrating significant moments in U.S. Black history that happened this month. So with your installment for Thursday, February 23rd, here's Bloomberg's Justin Milliner.
On this day in Black history in 1979, Frank E. Peterson Jr. was named the first Black general in the U.S. Marine Corps. His impressive service career began in 1950 when Peterson enlisted in the U.S. Navy. Peterson was inspired to join because of the Korean War. He was also inspired by Jesse L. Brown, the first Black aviator in the Navy. Peterson entered the Naval Aviation Cadet Program in 1951, completed flight training, and went on to serve combat tours in the Korean War and later in the Vietnam War. During this time, he would fly over 300 combat missions, notching over 4,000 hours in flight. Peterson was the first Black person to command a fighter squadron, an air wing, an air fighter group, and a major base. His work earned him accolades in both the Navy and the Marines, earning him the Marine Aviation designation of Silver Hawk and the Naval designation of Gray Eagle. This all led to him being an easy choice to be promoted to general in the U.S. Marine Corps in 1979. That's today in Black history. I'm Justin Milliner, Bloomberg Radio.
All right, Justin, thank you so much. You are listening and watching Bloomberg Business Week on this Thursday. We've got a turnaround certainly in the equity markets as investors getting a little bit more if you will, willing to take on some risk. This as yields are definitely off their highs of the session, excuse me. We're going to head over to our TV colleagues, talk about the markets. That's because Countdown to the Close starts right now.
countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. About 60 minutes left to go in the trading session here on this Thursday afternoon. Romaine Bostic alongside Shanali Bassick, joined right now by our colleagues Carol Masser and Madison Mills. Welcome to our audiences across Bloomberg Television, radio, as well as on YouTube. And Carol, I mean, we had a pretty strong start to the day in equity markets. That faded pretty quickly. But now as we get closer to the close, we're starting to see a lot of those bids come back in. Stocks not far from the highs of the day right now.
Pretty remarkable. I've been trying to kind of search around to figure out why we're off our lows. Maybe it's just hitting a level and investors finding some opportunities. One sector, though, and by the way, welcome back, Romaine. We missed you. One sector that's been outperforming throughout the day is the semiconductors. So let's bring it up for everybody. The SOX, most of the members, I think 27 of the 30 members in the SOX are higher. That average is up more than 3%. Thank you, NVIDIA, which is up 14% in today's session, moving up the most since mid-November. We know what it's all about. NVIDIA, upbeat outlook last night, suggestions of the import of artificial intelligence. You've got AMD also up 4% and Taiwan Semi up 4%, which makes me wonder if Buffett and Berkshire are maybe regretting a little bit of getting out of that multi-billion-dollar bet. We're going to hear, by the way, from Berkshire. Their annual shareholders letter comes out over the weekend, everybody.
Yeah, and I expect that a big topic in that letter is going to be the jobs market, right? Take a look at this. We expected to get 200,000. Instead, we got 194,000 jobless claims. This chart shows us that jobless claims always go up before a recession. We left out the pandemic because 2020 was a weird one. It was a little distorted. But the Fed discussed this in the minutes. We know this from yesterday. The Fed's take is that labor hoarding could be the issue here, hoarding on to some of that talent because of the labor shortage. But Romaine, I have to wonder if the Fed is going to continue to have that view as we get all this new data out, specifically the PCE as we head into tomorrow.
A lot of the mixed economic signals were a big part of the reason why you saw the rally and then, of course, the fade earlier in the day. I think to answer your question, though, Carol, as to why we're seeing this bounce now, it might have to do with some of those technical levels. Remember, earlier in their day, the major averages, at least the S&P and the NASDAQ, were retesting to the downside that 200-day moving averages. We were starting to hit some support levels and appear to be bouncing off of that. So that might be one explanation, at least from a technical level, as to why we're seeing a lot more green on your screen. 0.5% higher on the S&P 500, 0.7 on the NASDAQ, about 0.6% on the Russell.
Yeah, it's interesting. I'm going to take a look at the sectors for you to give you some more reasons, Romaine, to be happy today. You have the energy index up more than 1.4%. Information technology, which is where a lot of the love is, that's that NVIDIA love that you're seeing, more than 1.4% up on the day. Real estate also up about 0.8%. Industrials, healthcare. You are seeing financials essentially flat. You are seeing a couple down on the day, so a couple sectors. It's communication services, utilities, and those consumer stocks not getting the love.
Yeah, not at all here. Kind of that's your big laggard here on the day. I think it's kind of interesting, though, when we talk about sort of some of those consumer stocks. I mean, Etsy continues its outperformance here, up about 3% here on the day. So there are some sort of corners of the retail market that continue to do well. And, of course, this is going to be a big week for retail earnings here. Next week's going to be a big week for retail earnings. So we'll get a little bit more sense here as how some of their competitors fared. Meanwhile, you go to the top of your screen, you were mentioning sort of the big rally in NVIDIA, lifting AMD, Taiwan Semi, and a few others, also lifting Oracle. Oracle shares up about 2.4%, primarily because of that cloud partnership that it has with NVIDIA. NVIDIA, of course, the biggest point contributor right now to the S&P 500. Second biggest percent gainer actually belongs to Ansys. Those shares up about 10% here on the day, having a pretty phenomenal day here on the back of what I thought was actually pretty decent guidance here. The fourth quarter results not only beat guidance, but you talk about that full year forecast, really strong here when it comes to additional software sales. And we should point out a company also tied to the chip space, if that wasn't clear.
Analysts liking those numbers. They thought, considering the economic backdrop, they thought Ansys did pretty well.
Absolutely. And then you have Domino's Pizza, which is the big laggard here on the day, down 12%, biggest decliner in the S&P 500. I mean, sales were up, but I guess not up enough. There are a lot of more concerns, I think, about cost here. We saw those margins contract a little bit for Domino's, and you're seeing some of the other pizza companies also moving lower in the day, including Papa John's. I do want to go back here to the macro here, and you were showing a little bit earlier, Maddie, what we saw in the U.S. when it came to U.S. jobless claims. Let's go over to Europe here, because we had that latest inflation reading out of Europe for the Eurozone, and it was hot. It continues to be hot. You saw a reacceleration, particularly on core, back up to 5.3% from 5.2%. The headline number also moving higher as well. And this is raising a lot of concerns here about the stickiness of inflation. We already had this conversation, guys, I think, over the last couple of weeks about what was going on here in the U.S., but this does appear to also be a problem, Carol, as well as what's going on in Europe.
I'm so glad you brought that out, Romaine. Reading in this morning, I was thinking, it's a reminder that this is a global inflation battle, and all of the global central bankers are taking it on. So it's something to think about when we do it on a daily basis in terms of how it impacts the U.S. specifically. Having said that, I do feel like the smart conversation right now is, will the Fed continue to stick to that 2% inflation target, bringing it down to that level? Some say it can't be done, but nonetheless, right now, the Fed and Fed members are sticking to it. And John Williams of the New York Fed weighing in on that at an event last night at his bank, talking about the importance of price stability. Check it out.
Price stability is, in fact, the foundation of economic prosperity. Without price stability, all of the other goals that we have, whether maximum employment or low and stable or low interest rates, can't be accomplished. So that's an absolute imperative for us.
All right, John Williams, president of the New York Federal Reserve Bank, last night making some comments, but it's just a reminder, right? The dual mandate, they're looking at the labor market, they're looking at inflation, and that is John Williams reminding us that the Fed's going to do what it has to do to bring inflation down, and that means if the labor market comes undone, if the economy goes into recession, they're going to still, Maddie, stick on their mission.
Yeah, they're going to do what they have to do, but I have to wonder whether it gets a little bit harder for them to do any massive hikes as we enter year 2 of this same issue and this same conversation that we've been having. It feels like maybe it's a little bit easier to bump up those interest rates in the beginning than it might be now.
I mean, his comment about price stability is spot on, but of course it doesn't necessarily match up with the Fed's actions themselves. I mean, price stability was a hard 2% target. Price stability isn't 2-ish. Price stability isn't a range, and price stability isn't saying we're now going to go from 2-ish to 3%. I mean, either you're going to have a target or you're not. But what's the target? And this actually, and I'm not trying to be facetious here, this goes back to the issue too that a lot of people have talked about, that maybe you do need some more automated guide rails here for the Fed, whether it's something like the Taylor rule or maybe something a little less rigid, but at least something that provides more parameters and not just the gut of what these folks talk about when they go into that meeting.
It's so important, and I'm glad to see you hold their feet to the fire here. It's what the market would love too, because you've seen the expectations change so drastically that it becomes a credibility question at some point. And you see the minutes here and you see the more hawkish undertones here. But yes, I think there is that fear of raising rates too quickly and risking the economy at this time when things are seemingly going somewhat smoothly in terms of any potential soft or no landing. But I think our own Etta Harrison had a really smart insight a little earlier about this idea that a no landing is almost a bigger problem than a soft landing, because it means that inflation, 2%, 3%, whatever it is not under control.
Well, all I would say in terms of an exact number from the Fed, I mean, we know, Romaine, we talk about this. It's not an exact science. We're talking about all these different kind of landings because we just don't know.
For the record,
so that's the difficulty of the Fed. What?
And for the record, some people say economics isn't a science at all.
Well,
I'm just putting this out there. Talk amongst yourselves here. We'll be back in an hour.
I have a degree in economics. I know how I feel about that.
Oh, you do?
I'll come back to you on that one. All right, guys, it's a wrap. We'll come back in less than an hour's time. I know, surprise, surprise. I'll come back. We all will come back in less than an hour's time. I think we will all come back. Across platform coverage, right. Beyond the Bell. We'll get you down to the close at 4 p.m. Wall Street time. Today and last night, because man, it is on fire. Check out shares. They have now more than doubled from mid-October of last year when they hit a low. They're up, I think, around 60% so far this year. This is the world's most valuable chip maker again, which I had to double check. I'm like, wait, it isn't Intel. No, it's not even by a mile. NVIDIA easily has that position. Last night it gave an optimistic outlook. Maddie, we talked about it, and as we see the stock really helping lift the overall market initially today and really the chip sector.
Yeah, totally. The stock itself soaring today, up by more than 15% at highs today from the last time I checked. So we have a lot of questions about this. We're going to get you what you need to know with Bloomberg Intelligence Senior Tech Industry Analyst Mandeep Singh in our Bloomberg Interactive Brokers studio. Mandeep, thank you for coming back to talk with us about NVIDIA. I mean, what is your biggest takeaway today following earnings last night about just how great the stock is doing?
Can we ask, because you brought up a great question when we had Dan Morgan on, why did it take so long? They were late last night, weren't they?
Yes, and I think a lot of people were surprised they forgot to release their earnings and wanted to go directly to the call. It's happened before, but obviously it's a rare occurrence.
I couldn't tell, were they like popping champagne saying, whoa, this is great?
I don't know about
wait,
that.
we have to release them.
The revenue were down 21%.
Okay.
So it's just, I mean, look, the stock reaction was all about better than feared. And data center, that's the key segment for them. This company was predominantly a consumer gaming chip maker. Now 60% of their revenue comes from data center. That is the reason why everyone is enthusiastic, because when you talk about large language models, generative AI, all this is running in the data centers, the servers. The composition of those servers is changing from what Intel used to be in terms of the chip maker that powered these servers to NVIDIA actually bringing in their accelerators, and that's what's driving a lot of these servers.
All right, so help me out, because sometimes I feel like, certainly I do, but hopefully getting smarter in terms of dropping all semiconductors in one bag, and that you can't do that. They're different. There's equipment makers. There's different types of processors, if you will. So where is like Intel versus NVIDIA versus AMD versus TSM?
Yeah, so TSMC is a manufacturer, and they are a manufacturer of NVIDIA chips, they are a manufacturer of Apple chips, they're a manufacturer to everyone.
So they take the design, they just manufacture.
Correct.
Right.
Intel does both design and manufacturing, and that's why they had such a monopoly, because they invented the Moore's law, where every year you would package more transistors in the chip. That used to drive performance. Guess what? They have been not doing so well on the manufacturing side, which has been really the kind of their Achilles heel when you think about, why they have lagged behind so much over the last 4 or 5 years. What NVIDIA has done well is, one, they have been able to leverage their consumer gaming chip and really bring it on for this server use case where you could do large amounts of data processing. They call it training data set, which is basically petabytes of data that you can train an algo with. And the chip allows you to do that because it can process this large amounts of data. That is what they're selling to the enterprise servers. And look, that segment—
Which is the data center business.
Data center. So even though we know IT spending is slowing down, that part of IT spending isn't slowing down, because companies realize how important it is to power their data centers, because the amount of data around us keeps growing.
Right.
Like recession or no recession, one thing is a given, is the amount of data will keep growing.
You're a data generator, you're a data generator, I'm a data generator.
Right, it's exponential. I wonder though, when you talk about the data centers, there's also gaming, PCs, demand issues for personal computer chips. What do you think is the most critical element of NVIDIA to watch?
It's a data center. And look, I think on the call they talked about inventory correction. So overall, chip makers are going through an inventory correction. On the PC side, Intel has noted how, it may take 5 to 8 quarters to clear up that inventory, because these companies ship well in advance of the actual hardware makers, shipping their laptops or their PCs. So there is a lot of inventory in the channel that needs to be worked through. That's why, once the demand kind of goes down, it takes a while to work through that inventory. There isn't a lot of inventory on the server side. That market is still in balance, and that's why every segment is so different. So PCs, it will take a while to correct through the PC market. Smartphones, I would say, is also going through a correction. It's going to take at least 2 to 3 quarters before people start upgrading their smartphones. On the server side, companies want to refresh their data centers because they know that's where the cutting edge stuff is, the large language models. If you have to do it, you can only do it on the latest chips. You can't do it on your old servers.
It's great listening to you describe this, because then I think about equipment often has cycles, right? And that plays into certainly the chip side. But right now for data, it's just, as you said, exponentially growing, right? And so the demand, is it cyclical too, or no? Because we are just living in such a data-driven world.
Yeah, so you are adding more data centers capacity, in terms of the number of, and you also have to upgrade your old data centers, because your old data centers can't process this large amount of data either. So that is why the tailwind is so strong. And look, I think there will be a digestion phase. So think of who the biggest spenders on NVIDIA chips and servers are. It's your hyperscale cloud companies, your Meta, Alphabet, Amazon. They make up, those customers make up almost 50% of NVIDIA's data center revenue. They are the ones who are actually building a lot of their data, and that's where the customer concentration is huge, but they need it. That's what cloud is. Cloud is all the capacity that these companies have, on accumulated, and they're constantly upgrading it and making it available for everyone to use.
I wonder about the AI piece, because the CEO, as you know, obviously talked about that right at the top. How critical is that going to be for NVIDIA moving forward?
This is still a narrative-driven stock. So that's where, the fundamentals on the data center side are great. But look, it's trading at 20 times sales. Your Alphabet is trading at, 4 times sales. So you have to ask
what's up with that?
And I would argue this isn't even a recurring revenue model. Look, the reason why chip companies used to trade at a discount to software companies is because software companies have a recurring subscription model. This isn't a recurring model.
But is it a replacement model?
It is, but that's why it's cyclical. Because the replacement cycles are like every 2-3 years, and then you have to generate incremental demand. And what everyone is saying is NVIDIA has 5x its data center revenue in a span of 3 years. 3 years back, their data center revenue was $3 billion. Now it's 15.
Wow.
It can actually double again in 3 years. So the expectations are already high. That's what's reflected in the stock. Any change in assumptions in terms of slowing growth, that won't be good, I think, in terms of valuation.
I'm glad you brought up AI, Maddie, because we have all been obsessed with, recovering AI, and we're like, NVIDIA's the play. But they've been doing this for a long time, right? This whole idea of AI or generative AI, they've been doing this, right?
Well,
or have they not? Help me out here.
They have the chip, and they've been constantly improving, the speed and the power consumption and all the attributes that go with a product cycle. What they've done is, constantly find new use cases. Last year, NVIDIA was a crypto company. Then it was a metaverse company. Now it's an AI company. And I bet you tomorrow, if self-driving takes off, it will have, because that's the use of that chip, is it can be applied, that use
so many
case
different ways.
In different ways. You have to process data at the end of the day.
All right, only got about 30 seconds left here. Is there another NVIDIA? Who's the closest to NVIDIA out there in the semi space?
I would say AMD. AMD also makes GPUs, and Intel. If Intel catches up in manufacturing, they will eat some of NVIDIA's lunch on the data center. In fact, they are the incumbent. They have the 80% share with CPUs. It's just they're losing share right now because they haven't caught up on the manufacturing side.
Does it make sense to you that NVIDIA is the largest chip-making company in the world with a $582 billion market cap?
A lot of the good news and expectations are priced in. I would be worried because any shred of Intel catching up or getting a large contract from someone would be a game changer, I think.
Little perspective, Intel's $106 billion. That just blows my mind. Yeah. Thank you. That's the deep dive we were hoping to do, and you did it for us. Bloomberg Intelligence Senior Tech Industry Analyst Mandeep Singh, brilliant, his research, so appreciative, joining us in our Bloomberg Interactive Brokers studio. This is Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
3:21 on Wall Street. I'm Charlie Pellet. We check the markets all day long at Bloomberg. We have got green on the screen. It has been a choppy session, though. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney. All right, I've got it. We've got the Dow, the S&P, NASDAQ all advancing right now, with the S&P up 24, higher by about 0.6%. The Dow right now up 112. That is a gain of 0.3%. NASDAQ up 95, a gain there of 0.8%. We've got the 10-year yielding 3.87%. The 2-year 4.69%. Spot gold down 0.1%, 18.23 the ounce. And West Texas Intermediate crude up 2.3%, 75.63 a barrel. Bottom line here, stocks are moving hard. Just about 36 minutes to go ahead of the closing bell. Stocks are gaining in a jittery session before the PCE tomorrow. Again, recapping, S&P up 25, higher by 0.6%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You're listening and watching Bloomberg Business Week. Carol Massar along with Maddie Mills here in our Bloomberg Interactive Brokers, on Bloomberg Originals, and of course on YouTube. So I did come across a research note that talked about online gambling in the betting market globally, the size and share to exceed $114 billion by 2028, growing at a compound annual growth rate of nearly 11%. So we've got a great guest to talk about it. He's here in our Bloomberg Interactive Brokers studio. Charles Gillespie, is co-founder and CEO of the publicly traded small-cap gambling.com Group Limited. They operate in U.S., Ireland, and Malta. They are across the globe. You might know some of their sites, including gambling.com, bookies.com, and rotowire.com. Again, like I said, he's in studio with Maddie and myself. How are you?
I'm very well. Happy to be here today.
Well, tell us a little bit about your business in the industry and what you're seeing in the last year or so.
Our business is doing very well, and the entire industry over the last several years has shifted its focus away from Europe, which is kind of the historical home of regulated gambling, toward the United States, as the U.S. has become the center of gravity in this global industry. And the growth has just been phenomenal.
What's phenomenal? Give us an idea. Can you give us some ballparks?
Well, you've got, I think it's already up to something like 10 billion in the U.S. And if you look back 3, 4, 5 years, it was sub 1 billion.
But what kind of growth are you seeing on your sites?
Well, we delivered growth of 100% and nearly 100% in Q3 in the U.S. And the U.S. has been huge for us. It's really, our story kind of mirrors the global story for the industry. When we started the business,
coming off of lower levels, is that fair?
Exactly. Coming off of essentially nothing, 4 or 5 years ago. When we started this business back in the day, there was no regulated online gambling in the United States. So we left, and we ended up building one of the most important affiliate marketing businesses in the industry, based in Europe, with our biggest office in Ireland and our biggest markets really being the UK and Ireland. And then slow and steady, things started to change in the US. You actually got online casino gaming in New Jersey nearly 10 years ago already. And that was a big deal.
Huge.
But we didn't really see that, spreading across the United States 10 years ago. And it didn't. It took a number of years before the dam broke. And the dam broke in 2018 when the Supreme Court issued a ruling that invalidated this 1990s era sports betting ban, and that created the climate for what we've seen today, with regulated sports betting now rolling out, across the U.S., 20+ states already with online sports betting, and it's a states' rights issue, right? So each individual state is free to kind of do it the way they want, and
is your growth basically just banking on that, like just the growth going across the United States?
Yeah, we had a profitable, high-margin, high-growth business before any of this. Mm-hmm. And then you layer on this incredible growth in the United States, and it obviously gets very, very exciting. New York sports betting regulated, over a year ago already. That was the biggest launch to date in the United States. But the real prize that's going to come for the industry here is online casino games, right? Which is, frankly, has a very different margin profile. You know, if you think about sports betting, it's actually quite a low margin product.
What is it typically? I don't know a ton about this industry. I mean, I know generally, but so what's the margin in the sports betting?
Well, if you think about it this way, think about player values. You know, an online sports betting player is worth, you know, probably $1,000 to $2,000 plus, depending on the operator and
Like
how
that's
well.
how much they're betting? What do you mean by that?
That's what the lifetime value of the player would be to the online gambling operator that gets them through the door.
Got it.
And you know, we're in the business of referring players to the operators, right? So they pay us something, they don't pay us the entire lifetime value of the player, of course, but it's a very healthy proportion of that. And when you compare sports betting to online casino is roughly twice the value. Okay. Of course, there's not as many people that play online casino as bet on sports. It's a more kind of niche product where sports betting is quite, you know, mass market. Everybody can wrap their head around sports betting.
But in online casino, the volume, I would assume, like there are people who just play it over and over again.
Absolutely, and you know that's how the gambling industry works. It's
why the house
part of it is the odds.
Yeah.
Part of it is that house edge, but you know the other part of it, which people forget, is how many times you pull that lever.
Yeah.
If you only pull it once, even if the house edge is very high, it's not such a brilliant business. But if you pull that lever a lot, even if the house edge is very, very low, like it is in slots, it's a fantastic business. And
make it up on just the frequency.
Yeah.
Where does the macroeconomic issue come into play with that? Because, you know, we keep talking about whether or not we're heading to a recession this year. Is that concerning for the gambling industry?
No.
Do people gamble more when the economy's bad?
It's not that people gamble more. It's that the activity is largely resilient to the economy, even in fairly mature online gambling markets. You know, you look at the UK, which has had regulated online gambling for 15 years.
Yeah.
You know, and even in the UK, it's still growing by 8 or 9% a year. And in the US, the growth is so spectacular that any sort of headwind, which there isn't really, but even if there was a headwind, you probably wouldn't even see it.
You don't feel it.
You wouldn't feel it given the overall growth.
What's the biggest thing in the U.S. that drives people then? Like for the Rihanna concert that some people call the Super Bowl, was that a huge push for you guys? Is it stuff like that?
Absolutely. Player acquisition around sports betting is very event driven, and you know there is no bigger event than the Super Bowl. So.
Yeah.
You know, March Madness is also coming up in a very important time of the year for player acquisition.
Charles, how many people, these player acquisitions, could be you, could be me,
could be us, Carol.
Exactly. How many come in like on the Super Bowl? Can you give us an idea, range?
Well, you know, companies like ours would refer, you know, in any given month, we're referring, you know, over 10,000 new depositing customers.
On average?
Yeah, I mean, sometimes it's substantially more than that.
Right.
But you know, when you think about our business model, the online gambling operators, they only pay us when we've delivered a customer to their door who has signed up, been verified, has deposited, and has made a bet in a regulated state. So the value proposition we provide to them is crystal clear. And you know, there's a lot of talk these days about.
So you've checked all those boxes before you pass them on.
Well, that's their job.
Their job.
They need to do that, but they don't owe us any money until they've cleared all those checks.
Do most of those people clear?
No.
What percent? Is it like half percent? Like yeah, I'm just curious. Like, is it half?
I mean, it's tough to speak to, you know, each step in the process,
Okay.
but
Yeah.
you know, one of the issues is a lot of people sign up, but they're not in a regulated state. You know,
Right.
if you're in California and you sign up for DraftKings, you can't bet. You know, and that, you know, but if you hop on a plane and you come to New York for whatever reason, then you can. So. A lot of it is really education, and historically there's been challenges with payments. You know, especially a couple of years ago, a lot of U.S. banks just did not differentiate between illegal offshore online gambling and actually regulated tax-paying legal onshore gambling.
So you said on average about 10,000 that you're passing on.
It's
I
usually
understand it.
It's usually it could be a lot more than that in any given month.
But on Super Bowl, so like at a Super Bowl leading up to the Super Bowl, is it 5 times that amount? I understand over a lot it's going to even out, but
yeah,
yeah. Or if it's March Madness,
substantially more. We haven't even
we're
reported.
Bloomberg. Did they tell you we like numbers?
We love a number.
Just kidding.
We'll report Q4 on March 23, and we'll give a little color on Q1 at that point as well, I'm sure.
20 seconds left. It sounds very rosy. You seem like growth is coming, especially as regulations ease. 20 seconds. What is the one tricky thing for you in your business?
If there's any headwind at all, it's inflation, right? Talent is expensive, and our business runs on people. We do everything we can.
Workers and wages are expensive.
Yeah,
yeah.
That's
not good for the Fed. Yeah.
But we've got people all around the world, so we can manage that by hiring in lower cost jurisdictions if necessary.
It's something we've heard from every head of a company. It's all about workers and finding them and then being able to pay them. Charles Gillespie, come back soon. That was really fun. Co-founder, CEO of Gambling.com Group, here in our Interactive Brokers studio. Let's get a check on the latest world and national news. Off to Nancy Lyons in our 99.1 newsroom in Washington. Hey, Nance.
Thanks, Carol. Despite last-minute requests from defense attorneys for a new trial, today Hollywood mogul Harvey Weinstein received a sentence of 16 years for raping and sexually assaulting an actress in 2013. He's already serving 23 years in New York on similar charges. In South Carolina, prominent attorney Alec Murdaugh is admitting that he did lie about being at the family's dog kennels just minutes before his wife and son were killed. But he said on the stand today he is not the person who killed them.
I would never intentionally do anything to hurt either one of them.
Murdaugh says he continually lied because his drug addiction made him paranoid. Some questions are being raised about the forewoman in a special grand jury looking into election interference in Georgia. She's recently been making the media rounds, saying their report to the district attorney recommends charges against multiple people but has not named them. Bloomberg's Eric Larson says at this point it seems she's not overstepped any legal requirements.
It's kind of bad optics for the district attorney, of course, but there's still another layer of protection with this other grand jury that would need to be called on to issue any actual indictments.
Bloomberg's Eric Larson. The National Transportation Safety Board is out with a preliminary report on the train derailment near East Palestine, Ohio. NTSB Chair Jennifer Homendy says it shows a wheel bearing overheated and the crew may have tried to stop the train when they realized something was wrong when readings reached above 250 degrees.
There are a number of causes for overheated roller bearings. These could include fatigue cracking, water damage, mechanical damage, a loose bearing, or a wheel defect, and we will look at all that.
Homendy says the crew did follow appropriate procedures. Global News 24 hours a day. I'm Nancy Lyons.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:41 on Wall Street. I'm Charlie Pellet. We check the markets all day long at Bloomberg, and this update is brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds. See if your business is eligible for employee retention credit assistance with the team at Innovation Refunds. They help make the process easier and less stressful so you can focus on your business. Learn more at getrefunds.com. A tech rebound driving the stock market higher in a session of many twists and turns. We have got just about 19 minutes to go ahead of the closing bell. Also ahead of inflation data tomorrow that will help shape the views on whether a soft landing is still on the table. S&P right now up 29. That is a gain of 0.7%. The Dow up 144, higher by 0.4%. NASDAQ up 110, a gain of 1%. We've got the 10-year yielding 3.87%. Spot gold, little change, down $2 the ounce at $18.23. West Texas Intermediate crude up 2.1%, $75.53 a barrel. One of the market's big concerns is whether a resilient economy will force the Fed to keep hiking for longer. Callie Cox is investment analyst at eToro USA Securities.
We have Fed speakers stepping out and saying, maybe a 50 basis point hike is warranted. Maybe we should reaccelerate. And markets are pricing that back in. From our side, we didn't expect a rate cut anytime soon. We expected maybe a little bit of excitement around the fact that inflation is coming under control, but maybe it's not coming under control as quickly as people think. So I think that's just shifted the mindset a bit.
Lots of earnings coming up after the close of trading. Among the companies scheduled to report, Warner Brothers Discovery up now by 2.1%. Intuit up 1.6%. Autodesk up 1.9%. But trading lower now, Carvana down less than 0.1%. Also reporting after the bell, Beyond Meat down now by 0.3%. And that is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, just about 17 minutes left in today's trading session. Quite a turnaround when it comes to the equity trade. Who'da thunk? We started with some gains, then we sold off, and now we've bounced, and we're almost at our best levels of the session. You heard Charlie talk about the trade, and more economic news, strong labor market, everybody trying to figure out that, the Fed's going to continue to be aggressive. Yields, though, Maddie, have definitely worked off their highs of the session.
Such a flip-floppy day today. I'm excited, though, to have our next guest on to kind of clear up some of the confusion here. We've got Ryan Detrick, Chief Market Strategist at the Registered Investment Advisor Carson Group, via Zoom from Charlotte, North Carolina, joining us from there. Ryan, thank you so much for being here to chat with us. First off, you're based in Omaha. You're in Charlotte right now, but we always talk about the Fed. We're here in New York City. What is the perspective on the Fed and the macro issues from the Carson team in Omaha? What do you spend a lot of your time talking about?
Yeah, guys, thanks for having me back, first off. I mean, we talk about the same things everyone else, right? I mean, is the Fed really going to be as hawkish as what we're seeing, what yields are saying? Are there really going to be a 50 basis point hike at the next meeting, maybe another one, 6 weeks later? I'll just put it like this. We've been saying for a while we would avoid a recession this year. We were kind of in a lonely camp when we were saying that. People are coming on. The economy's strong, and I get it. That recent PPI number a little hot. The recent CPI number wasn't perfect. But we look at wage growth, right? Hourly earnings. Hourly earnings have been fairly calm. That ECI number, Employment Cost Index, something the Fed watches very closely, came in lower than expected a couple weeks ago. So things aren't perfect, but we're not so sure the Fed's going to be quite as hawkish as what people say. And again, we think we're going to avoid a recession, and that all in all should be positive in our view.
So when you then, Ryan, take a look technically at the markets, what is it that supports additionally beyond the economic data points? What within the market trade tells you that we're going to avoid a recession?
Yeah, well, I mean, great question there. I'll put it like this. Look at what's leading us, right, this year. It is the more aggressive things. The only things negative year to date, Carol, so far this year are like healthcare, staples, utilities, I guess energy's in there too. But the more defensive things, 1 year ago right now, the war started, by the way, tomorrow, 1 year anniversary. If you look at what was happening before that, it was the exact opposite. The defensive stuff was leading. We are getting some of the more aggressive things. And I know people say it's just the junk that's leading. Listen, I'm not so sure I'm buying that. I mean, we're seeing industrials not that far from an all-time high. Industrials, when they're strong, that's good. Now, about the market, just for a second here. You know, the second half of February, we've been talking about this a lot, that Carson Group to our advisors. The second half of February is not good. It's usually a hangover month, right? We had a pretty good party the first 6 weeks of this year with the 11th best start to year ever as of Valentine's Day.
Right.
To see some weakness right now isn't abnormal. Just think about this for the listeners. The previous 10 years that were better than this year this is a pretty good year. The rest of the year from Valentine's Day to the end of the year was higher 9 times with some really good performance. So it's kind of that, so goes January, goes the year, a different look at it. But the truth is we're seeing strength across the board from the right groups. We're having a pullback right here in a weak seasonal time frame. And hey, look at that sell at last point. That 2% drop the other day, it was ugly. Look at the volume. It was really light, right around the 3-day weekend. Some of us had a 4-day weekend. That's not too bad to see light volume on a sell-off, and that's what we've seen the past couple days.
Well, and are you thinking from a technical perspective that we're going to see that traditional idea of the bad performers of 2022 becoming the good performers of 2023?
Yeah, we're not so sure there. Cyclical value did fairly well last year, and I know energy was the big winner. I get it, and some of the defensive things. But since the October lows, cyclical value has done well. I guess the big question is, what do you think of tech, and what do you think of communication services, right? Those were the big losers last year. We're still even weight those. I just had a meeting before I jumped over here talking about our sector allocations, and we're sticking with the cyclical value names, your industrials, financials, materials. We're more even weight as it comes to tech and communication services. But just the fact that they're going higher finally, I don't think that's a bad thing. Look around the globe. My goodness. I mean, some European ETFs are literally making all-time highs earlier this week. So we're seeing more participation broadly across the globe, wildly different than 12 months ago right now.
But volume has been pretty weak over the last month or so, Ryan. We've certainly seen that pull back. So there's one thing to consider. The other thing is our Elena Popina had a great story, basically how the S&P 500 took a ride to nowhere during earnings season. So we're talking about from JP Morgan to Walmart. But I think it's really important. She says, corporate earnings have served as the cornerstone to the stock market's gains during much of the last decade. In fact, some 90% of the S&P 500's gains in the decade through 2022 have occurred when America's largest firms posted their scorecards. So, to not see that, how does that factor in?
Oh, I mean, I'm not overly concerned there, Carol. We had a 17% rally off the October lows, into middle of this month. And I'll tell you, I think it's just more consolidation. And yeah, earnings season, let's be honest, earnings season wasn't very good. I mean, some companies had good things to say. Overall, it wasn't very good. And just to say, hey, stocks were flat after the big bounce we had into earnings season, that's something we're looking at. Last comment here, and I know everybody talks about this, but the dollar was historically strong last year, still playing, still a headwind for a lot of multinational companies. We think the dollar is going to weaken this year. The Fed did its thing. A lot of other central banks are more aggressive. A weak dollar should be more of a tailwind to global earnings as we reach the second half of this year. And we think earnings come in a little bit better than most people expect this year. Again, as we can avoid a recession, thanks to that consumer, which is still pretty strong.
So you're a bull.
Yeah, we are a bull. We think S&P will gain between 12 and 15% this year. We said that back in December. We said we'd avoid a recession back in December. And we like small caps a lot. We didn't talk about that one. One final comment there. We like small caps. They've been leading. Small caps did not make new lows back in October from the June lows. That was a sign from the market that something was going on. Nobody knows what exactly, but small cap leadership's a good thing. And we still like small caps. And if you don't avoid a recession, that's a place you want to be.
We've been talking about small caps a lot this year.
Yeah, I know. Right.
Yeah. The Russell 2000 has been popping up quite a bit for us. Ryan, do we have maybe 10 seconds for you? Do you see disinflation happening in what you look at?
Yeah, we do. We see, it seems a lot of people. We see rents going down a lot faster. We see used cars going down a lot faster. Those are bigger parts to this core CPI than they were this time a month ago. And the second half of this year, disinflation should take place.
All right, we shall see. Ryan Dietrich, thank you so much. Good to check in with you once again. Chief Market Strategist over at the Carson Group, joining us via Zoom from Charlotte, North Carolina. Yeah, we've definitely got a market turnaround as we've been talking about. As we said, yields have definitely backed off their highs of this session and stocks have backed off their lows. So we'll continue to track the market. Count you down to the close with about 10 minutes to go. This is Bloomberg.
Your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. Oil and gas exploration company Pioneer Natural Resources says it does expect to return a, quote, significant amount of money to investors in 2023. This morning it reported fourth quarter results that analysts said showed a high-quality beat. CEO and founder Scott Sheffield spoke with Bloomberg Television this morning, and he says if you want to know what's happening with the price of crude oil, definitely keep an eye on what's happening in China.
Yeah, I think over the last 5 to 6 months, oil has been range-bound. Obviously waiting to see what happens in Chinese demand. Chinese demand is picking up significantly. Most people predict about an 800,000 barrel of oil per day to about 1 million barrels of oil per day. If you look at most forecasts, I think we'll see oil eventually Brent will break 90 this summer. and climb back up to $100 sometime in the second half of the year.
And indeed, to keep that forecast in perspective, Brent crude right now at 82.30. Again, he sees it going to 100. West Texas Intermediate crude 75.48 a barrel, up today by about 2.1%. Shares of Pioneer Natural Resources down 0.2%. NVIDIA rallying after earnings. NVIDIA shares up now by 14%. Wayfair shares down the most in 9 months after the company reported a worse than expected loss and a 19% drop in active customers. Wayfair right now down by 22.3%. Wayfair based in Boston. And those are some of our top company stories. I'm Charlie Pellet, and this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
All right, everybody, this is Bloomberg Business Week on this Thursday, February 23rd. Tim, as you know, is on leave. Carol Master along with Maddie Mills, Bloomberg Quick Take. And just a few minutes left in the trading session. We're going to talk with our TV colleagues in just a moment. Having said that, a couple stories certainly front and center for us. First, I want to get to the average 401k balance. This is by our Suzanne Woolley, who joined us yesterday. The average 401k account at Fidelity Investments lost about a fifth of its value in 2022, tumbling to $103,900 from almost $131,000. This is according to a report that Fidelity put out today. No surprise, if you've been looking at your 401k, you know exactly what happened.
It's a reminder to me, though, of why we make the joke of why we don't want to look at our 401ks, because it's so traumatic to see that big of a dip, 20%. But it's interesting following Suzanne's conversation we had with her earlier this week.
Right.
We did this survey, the MLive Pulse survey. You can type in MLive on your terminal to see it. And most of the respondents, their investor types, said that you need between $3 and $5 million to retire comfortably.
Which is why a lot of money managers say, you know, you're investing for the long term, you're going to have ups and downs, and you just kind of leave it in, and that over time it builds. But nonetheless, 20% hits, you really feel it. That's why folks like Tom Keene on Surveillance talk about your 201ks or your 101ks. Yes. In the meantime, one story that is among the most read, we did want to bring it to you, has to do with Jamie Dimon. When he speaks, you know, he was there during the financial crisis, the last big head of one of the big banks on Wall Street that is still there since the crisis. Well, he came out, made some comments on CNBC today, and he said the U.S. economy has obstacles to overcome, though there's still a chance for a so-called soft landing. He says the U.S. economy right now doing quite well.
Right, he talked about consumers having a lot of money, they're spending it, jobs are plentiful. He did say there's some, quote, scary stuff out there. Of course, he is talking a little bit about, you know, Russia, Ukraine, oil, gas, war, migration, China, of course. But I love thinking about Dimon's take that it's time for another recession when it's been 8 years since the last one. And it's been the time. I mean, we're due for another one.
We talk about the markets, we talk about an economy, there are cycles, no doubt about it. And I feel like all those geopolitical tensions, that's something we addressed with Ed Price yesterday, which you can catch on our podcast feed, and it's coming up in our weekend show on Saturday. All right, folks, just a few minutes left, about 2.5 minutes left in the trading session. We're going to head over to our TV team for our cross-platform coverage. Count you down to the close on this Thursday. Beyond the Bell, it starts right now.
On this Thursday afternoon, stick with us, full market coverage as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Shanali Bostic. We're counting you down to the closing bell, and here to help take us beyond the bell. It's a global simulcast. Rejoined right now by a smiling Carol Master, economics major, I'm told, and Madison Mills. No idea what she majored in, but she looks smart as well. Welcome to our audiences across Bloomberg television, radio, as well as for those folks streaming on YouTube. Crucial moments of the day. I'm not sure there's any one. This has really been all over the map here, but the end result, at least right now, Carol, looks like green across the screen.
Yeah, absolutely. Look at us, way off our lows of the session when it comes to the equity trade. We've seen yields come in. I do think about Jamie Dimon and his comments that he made on CNBC, this idea that maybe we do miss a recession. So maybe it's, you know, investors thinking, Maddie, okay, we're going to continue to see higher rates, but look at the job market. It's strong. We're still out there spending. Maybe we will indeed get a soft landing or no landing at all.
Yeah, the consumer just continues that resiliency, right? But we also, Carol and I just talked with Ryan Dietrich. He's a technicals guy, and he basically said, well, the market's selling off because it's the end of February, and that's what happens at the end of February every year, Shonali. So I have to wonder whether or not this is just a little bit of the market doing what it does.
Yeah, and also there's a lot of herd mentality in this market. Let's remember how many of those herds fled right into the semis and things like NVIDIA right before this positive result. So a little bit of relief for some people who might have lost a lot of money last year.
Yeah, we should point out, though, you sort of add this all up. This is still a pretty range-bound market here, and you sort of wonder what's the next catalyst that allows this market to break out of that range, whether it's to the upside or to the downside, Carol.
Yeah, no, absolutely, and that's something I'm watching on those lows that we saw in the S&P last year, seeing to make sure that we stay above it and don't take that out to the downside, Romain.
A 200-day moving average on the S&P 500 of 39.40. We should point out at one point here on the day, it looked like we were going to test that to the downside, but it bounced off a couple of key support levels here, has us closing higher on the day, to up about 21 points as we wait for these numbers to settle, or about 0.5%. Dow Jones Industrial Average higher by about 111 points, or 0.3%, while the NASDAQ Composite is going to close higher by roughly 0.7%. The outperformer on the day, that belongs, well, to a certain extent, Dow Transports, which are up 1% on the day. Russell 2000 finishing the day higher by 0.7%.
That's interesting to hear about transports. I'm going to go back to something we talked about earlier, and that's the semiconductor space. You mentioned it too, Romain, several times. The Philadelphia Stock Exchange Semiconductor Index, the SOX, up 3.3%. So, Maddie, definitely some outperformance there.
You know, I really want to take a look at a lot of these sectors here on the day, because to your point here on semis, Carol, just look at that rise in semis, over 5% on the day. You got a lot of love there, helping the S&P higher on the day. As Romain said, just dragged it right out of the doldrums. Transportation, energy, both up more than 1% on the day. Real estate, there's a lot of worries about that industry, but up almost 1% on the day. When you look at the red on the screen, you're not looking at as many sectors that were down on the day, but insurance, communication services, media, entertainment. You have food and staples and consumers. There's still some worries there, and you saw it in the red in the S&P today.
All right, that's your sector breakdown. Let's get to some of the specific gainers in today's session. And NVIDIA, man, it's just the standout. Top in the S&P 500 and NASDAQ 100, holding on to most of its gains for the day. At its highs, up 15%, closing with a 14% gain. You know the story. We broke the earnings last night. An upbeat forecast, and the company talking about AI in particular. This stock has more than doubled since the October 14th, 2022 low, and it just set off a rally in the whole semi space. So certainly an outperformer. Want to talk about something Romain mentioned earlier, Ansys. This one was up about 10.5%. Also top in the S&P 500 and NASDAQ 100. It's about a $25 billion market cap company. It's up about 20% so far. Software for engineering and manufacturing. Reported last night. Fourth quarter results beat. Company gave a full year forecast that analysts see as strong, especially, as analysts said, against a difficult economic backdrop. And one more for you, Dish Network, up 5% in today's session. Despite a fourth quarter revenue miss, analysts noting some positive signs that the company's wireless subscriber trends look promising. So that one, certainly some outperformance there, Maddie.
Well, I'm going to bring you your decliners here. We've got Netflix down by about 3.3% on the day. That is after the streaming platform lowered the price of subscriptions in over 100 countries. That was mostly in lower income regions where the company does have fewer customers, looking to gain a little bit of market share there. This could be that kind of move, but this impacts more than 10 million subscribers. Investors not necessarily liking that move today. The shares fell as much as 5.2% on the news about those price cuts. And then I want to go to Dollar General. We've been talking about all week these consumer discretionary companies falling as much as 3.6% on the close after the retailer's preliminary earnings per share and sales for the fourth quarter missed consensus estimates. Really interesting to me to see how these consumer discretionaries are holding up this week. And then I'm going to end on Wayfair, down by its most in 9 months, down by as much as, I think, a little over 23% on the close. That is after worse than expected losses and a 19% drop in active customers. So again, Romain, that could be related to changes in consumer spending, people looking for more services than goods at this point, but really interesting to see how Wayfair is holding up.
Yeah, interesting. A couple other decliners. Keep an eye on some of those EV stocks. Lucid had an awful day, and a lot of concerns about softness when it comes to demand for some of those vehicles. Take a quick look at the yield space. A little bit of stasis here on the day. We talk about the big sell-off that we had over the previous few days that had pushed yields higher. Relatively unchanged here on the day, at least at the short end of the curve. But at 4.7 here, that's nothing really to write home about here on a 2-year yield. Your 10-year still camped out just under 3.9 here, about a 4 basis point move lower here on the day here. Then your 20-year and 30-year saw similar moves here on the day.
All right, so let's get to Warner Brothers Discovery. This is a stock that we know has been on a tear, up more than 65% so far this year. Coming out with fourth quarter numbers, key total subscribers, 96.1 million, a little bit light. Street was looking for 96.3 billion. Let's go to the top line, fourth quarter revenue. That too is coming in light, 11.01 billion. The Street was looking for 11.23 billion. And then if we go to the earnings per share, fourth quarter loss per share, 86 cents. The estimated loss was for much less than that, a 13-cent loss. So, you know, Romain, to see the stock, which has been on a tear here, no surprise to see it down about 4% in the after hours.
Yeah, interesting. I'd be curious to see what they say on the call, because this looks like this could become now more of a cost story rather than a growth story here. We did get a few other earnings, too. I don't know if we can hit booking real quick on the travel space. I know you keep a close eye on that, Carol, but their revenue in the fourth quarter did come in slightly above estimates at about $4 billion. The Street was looking for about 3.9, and adjusted EPS also came in well above Street estimates at 24.74 versus an estimate on average of 21.51. I'm not really seeing any guidance in here just now, but overall, when you look at gross bookings, when you look at revenue, when you look at the number of room nights sold, all of these metrics appeared to come in higher than what the Street was expecting, at least for the fourth quarter.
Yeah, Romain, I'm glad you bring up those room nights, because another area I'm looking at from booking is rental car days sold, up by 27%, and then airline tickets sold also up by 61%. So that consumer demand for travel, just saying, so sticky, according to those earnings, Shanali.
Yeah, I wonder how the market's going to soak all of this in tomorrow, because Warner Brothers is certainly a large company in the game here, but this is some positive signs that people are still spending money when you're looking at booking holdings, and the market after hours, of course, is reacting well to it.
All right, so we've got entertainment, we've got travel. How about some Beyond Meat?
You like football?
Oh, yeah, I want to go to Beyond Meat.
No, forget Beyond Meat. Look at this. Jeff Bezos hires an investment firm to mold. This is the headline, and our readers need to know this. The Washington Commanders, of course, we know they've been in play. This is a big NFL football team in Washington. Jeff Bezos hires an investment firm to mold a Commander's bid. We should point out this is according to the Washington Post.
Another billionaire buying a sports team.
Yeah.
Wait, have I
Doesn't he also own the Washington Post?
Exactly.
All right, no, listen,
Quite the scoop there.
there's a ton of money. You know, we have the Business of Sports podcast. We do a lot of shows.
Are
There's
people
tons
still
of
eating
money in
Beyond Meat?
sports. Well, check out that cover story on Business Week.
Business Week story, that's a big one.
Well, here's a forecast for
the shares up 11%.
Beyond Meat sees 2023 net revenue of $375 million to $450 million. The estimate is for 394.2. What is Beyond Meat doing in the after hours here? Let's pull it up if we may. That stock, just taking a look, it's up 10% in the aftermarket.
I just said that like 3 seconds ago.
I don't listen to you. It's up 39% so far this year. So
not bad.
No, exactly.
Yeah. I mean, you're seeing a lot of love come back into these stocks. You know, we're also waiting for Block to report too. If you believe it or not, I mean, that's a stock that's up more than 17% on the year as well. So a lot of love coming back into these names. You've got to wonder how long that lasts and what the earnings really mean for it.
Yeah, absolutely. And I mean, Beyond Meat, of course, one of the really big beaten down type stocks out there, and whether they can turn that business around, or whether this is maybe just a one-off here, remains to be seen. I feel like that's the story, though, with a lot of these companies that we're getting. I know we're going to get Carvana a little bit later, talking about a company that's been beaten down here. But the question is, what is the longer term story here? Is this going to become a growth story once again, or is this going to be much more about keeping costs under control and maybe trying to I guess to a certain extent, almost shrink the business a little bit in order to sort of restabilize it?
Yeah, we've been talking to a lot of guests, Romain, who always, the big thing that they're talking about is pricing power of these companies and making sure that they continue to have that as much as they can as we face some of these macroeconomic headwinds.
All right, and just, you know, keep in mind, Beyond Meat, very high short there. So you're seeing probably some covering. Quick headline, Boeing halting the 787 Dreamliner jet deliveries. There you have it from the Wall Street Journal. All right. I guess that's a wrap. That'll do it for our cross-platform coverage, radio, TV, Bloomberg Originals, and, of course, on YouTube. We will see you again for Beyond the Bell, same time, same 401k account. This was from Fidelity, losing about a fifth of its value in 2022. We know that. We know what happened with the stock market, certainly in 2022. We talked about it, never ending. We had that MLive Pulse survey this week, global investors, right, saying that if you want to retire comfortably, you're going to need between $3 and $5 million. We have a great guest to talk about a lot when it comes to retirement and where to put your money.
Yes, we are very lucky to be joined in our Bloomberg Interactive Broker Studio. Sorry, guys, I had trouble getting my words out there. With David Musto. He's president and CEO of Ascensus, an independent record-keeping services company and third-party administrator of retirement plans, among other things. And David is joining us now. David, thank you so much for coming in to talk with us about probably like the most important decision we all make, how much money to save.
Agreed, and thrilled to be
retire.
here.
Tell us what's top of mind for you right now.
Well, you talked about people's accounts being down, and that's true. But really the important takeaway is we need to be consistently saving over time and increasing our saving over time to really set ourselves up for a successful retirement. One of the things that's been great to see is that there's been a lot of consistency and resiliency in the American saver. So despite all of the headwinds, despite everything that's going on in the environment.
So even through the pandemic is what
Even
you're
through
saying.
the pandemic,
Wow.
the average contribution to 401k plans has remained stable. We haven't seen very high numbers of people taking loans. We haven't seen significant increases in the people taking hardship withdrawals. There have been some slight increases, but on the margin, you're talking about 1% to 2% of participants in plans.
Is it because a lot of people who have 401k plans through their work, a lot of those people stayed employed?
A lot of those people stayed employed, and we've been well trained. Think about the last couple of decades, right? Dot-com bubble burst, 2008, 2009 financial crisis. People have been learning that staying put, right, being consistent, continuing to save over time is the best way to see through those difficult periods. So it's really good news. Now, the bad news is we have 25% of Americans that don't have any retirement savings.
Right.
About 40% that would say they're not on track to a successful retirement. And guess what? That number's probably low. There's probably more people that truly aren't on track. It's 55 million Americans that don't have access to a workplace retirement program.
Well, this was going to be my question for you about pandemic saving. You mentioned those of us who are lucky enough to keep working and saving, but I wonder if you have any insight into the data about those people who were like really struggling through the pandemic. Did they cut back on their 401k savings, or were those folks already not saving?
Yeah, we've seen the people that are on track and saving continue, right, by and large. We have seen people saving for other purposes outside of retirement beginning to decline somewhat. So 529 education savings programs where you can put aside money on a tax advantage basis for your kids' education. We've seen a slight downtick in the contributions that are going into those plans. Many Americans are saying, well, if I have a choice of putting money to my long-term retirement or doing tax advantage savings for my kids' education, I'm probably going to stick with the retirement and self-fund the education.
Is it a choice, or is it a case of demographics?
Connection
or something?
lost.
Like,
Well,
what's-
for
Or like
some-
education too, right? Like, does everyone know about saving?
Well, great question. 40% of the people that should know about tax advantage savings for education have never heard of 529 programs. So big upside opportunity for take advantage of. Now there's Americans that have the discretionary income to be able to maximize their 401k plan, maximize their 529 education, maximize their health savings account, which is going to be increasingly important for people as the healthcare costs increase in retirement. But there's a lot of other people that do need to make a choice.
I was just going to say, to be fair, we talk so much about our economy that it is really built on the backbone of a lot of small businesses, which I don't necessarily assume. I mean, in small businesses can be a handful of people to more than a handful of people.
Yeah.
It's quite a range. But I do wonder, in the small business community, do you increasingly see that they're being offered up 401ks to their employees? Because I do feel like as a result of that, a lot of people get left out.
Yeah, that's
just because how do they do it?
You're spot on. That's where the challenge has been. The 55 million plus Americans that don't have access to a workplace plan are probably working for a small company. Companies with fewer than 50 employees or so, probably only 50% of them or fewer offer a 401k program or some other defined contribution program. So there's a lot happening right now to try and create a better environment for small companies to start programs. You just saw the Secure 2.0 Act, which was passed by Congress in December of last year, which created tax incentives for business owners to start plans. They can actually get a credit for the full setup cost of a new 401k plan, and also get credits up against matching contributions for employees. That's a big deal.
That's interesting because I think the cost is the match, right?
That is a component. There's also startup costs, though, to getting the plan off the ground. Is it expensive for
a company to do it?
Listen, in the total scheme of things,
Yeah.
no. It could be a couple of $1,000s, $4,000, on an annual basis for a very small company to be able to offer a program, and they could do it considerably less expensively as well. There's also in the small business community, because of the focus on building that business and making sure that it's successful, less of an understanding of some of these opportunities. And the environment's become a lot better to start up a program.
I'm assuming a tight labor market has something to do where companies have to think about what they're offering up employees.
Oh, you'd better believe it, right?
Yeah.
So now the competition for talent, we see this when we talk to our clients. They say the first question I'm getting asked, or one of the first questions from prospective employees, is tell me about your benefits. Tell me about your 401k plan. How big's your match?
Yeah. Have you done that as you've popped around to different companies?
Yeah, I mean, I
before you came to us, and then you were like, whoa.
Well, yeah, I came here and then I found my forever home, of course. But before that, I was working in media, and I've worked at places where they think it's hilarious that someone would ask for a match. You know what I mean? But it's really hard because how do you stay at a company then as employees, start to grow up? We're like, you're forcing me to quit, So it's such a critical thing.
Right.
The retention aspect, I would imagine, they save on retaining talent.
Yep, for sure. People are seeing that significantly. And, another point here is particularly for younger workers, people entering or starting their careers, getting on the right path to saving. Inertia is a powerful thing, and it's a very negative thing if the inertia is in the wrong direction. So a big thing right now in our market is auto features and plans. When someone joins a company, they're automatically enrolled in the 401k plan, and their contributions are automatically escalated each year. And the individual can say, hey, listen, I want to stop. But once people are
you
on
have to
that,
opt out rather than opt in.
And once people are on that path, 80% of the people stay on the path.
This is something that my friends and I have talked about a lot, with inflation being what it is, and especially in New York City with apartment rents being what they are. A lot of my friends said, I have to decrease my 401k contribution to be able to afford my groceries right now. Are you seeing that particularly in the millennial age group, like 20 to 30s, decreasing?
Yeah, we see that younger cohort challenged with that kind of a decision.
Yeah.
Right. And our advice, right, is to yes, you need to provide for food, clothing, and shelter. But if you're going to make sacrifices and compromises, that's probably the place to do it. Not starting the proper path to long-term savings, because it's going to have a tremendous impact on your life and on the financial security of your family longer term.
It is amazing. My mom was always like, pay yourself first. But there is something about teaching kids so they start early, because if you really start early over time, it's amazing how it grows, and it makes it easier.
The discipline's important. We have a app, as many companies do. And when we have a participant in a 401k program go in to decrease a contribution rate, we will show them a projection of what that extra couple of $100 means.
Our 401k
in terms of income, right? When you're 55 or 60, and guess what? 30% of the people who thought they were going to reduce their contribution don't do it.
It's very motivating to see what a bad decision it is, right?
Yeah. It's amazing when you play around the numbers. Ours does the same thing, and you're like, oh, okay. So really important. This is such an important, topic, because I feel like we've been talking about financial literacy for such a long time, but it is really important in terms of, a person's financial future, especially when you don't have companies offering pensions anymore.
You bet. And that's why workplace programs are so important, because I hate to say it, education doesn't work.
All right, David, we got to run. Come back soon. David Musto, President and CEO of Ascensus, joining us in studio. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:21 on Wall Street. I'm Charlie Pellet. We check the markets all day long right here on Bloomberg. Beyond Meat shares surging 13% after hours. Its fourth quarter net revenue topped analyst expectations, while its adjusted loss per share was narrower than the average estimate. Certainly a stock we're keeping an eye on after hours. Warner Brothers Discovery, that is the parent of TNT, CNN, and other TV networks, reported quarterly sales that missed Wall Street expectations, hurt by a decline in ad revenue after hours. Shares of Warner Brothers Discovery down by 2.1%. Turned out to be an up day for the Dow, the S&P, and NASDAQ, with tech shares leading the way in a jittery session before inflation data tomorrow that will help shape the views on whether a soft landing is on the table. S&P up 21 to 4,012, a gain of just about 0.5%. The Dow up 108, up 0.3%. NASDAQ up 83, a gain of 0.7%. 10-year yield 3.88%, with a 2-year yielding 4.69%. Spot gold 18.22 the ounce, down 0.2%. West Texas Intermediate crude up 2.2%, 75.60 a barrel. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Bloomberg Business Week brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds. They may be able to help your small to medium-sized business qualify for ERC assistance. So what is the ERC? It's a tax credit for the sacrifices businesses made for keeping employees on payroll during the pandemic. Let Innovation Refunds help you grow your business. They don't get paid unless your business receives its refund. You can learn more. Just head to getrefunds.com. We're going to get right to it, Maddie, because Season 8 of Bar Rescue debuts this weekend on the Paramount Network. My husband and I, we definitely have binged on Bar Rescue in the past. Back with us is John Taffer. He's host and executive producer of Bar Rescue, creator of his own restaurant franchise concept. It's called Taffer's Tavern. They're in Georgia, they're in Maryland and DC, and they are growing. He is here back with us in our Bloomberg Interactive Broker studio. So nice to have you here. I feel like we're getting back to normal.
I feel that way too, but not quite. There are things that aren't happening yet that need to.
You came in and you're like, I got to share something with you. Tell us what's going on. Why are things not quite back to normal, John?
Well, you know, in my life, outside of television, in my practice, I help independent operations and I help large corporations. So I get a good perspective of both sides of that fence.
Right.
There's a tentativeness out there. Operators have been stung a little bit. When we used to make bold decisions, we're not quite making bold decisions right now. We've sort of stepped back in this conservative mode, if you will.
Right.
We're a little scared of employees. We can't lose them. We can't find them. They're sort of in control of the moment a little more than we are at times. That's concerning. Our costs are concerning. And then we're all facing this issue of value proposition, Carolyn. What I mean by that is, if my steak goes up in cost $3,
yeah,
I got to charge you $9 in of our restaurants. So we're fighting that value proposition. We're dealing with the employees, and we're stung. So the industry isn't rising at the level I was hoping it would,
right,
because of this tentativeness.
So meaning what? They're not opening up new establishments? What is that? What does that lead to, John?
You know, it's not only opening new establishments, it's taking bold steps into promotions, new day parts, new menu items, new creativity, new marketing programs, all the things that we would do to energize and keep our concepts fresh and entertaining. None of that seems to be happening right now.
What's the biggest mistake that you see people making of all of those that you mentioned that you miss?
Yeah, you know, I think that there's this view today that the customer will understand. Right? Customers know that we're short-staffed. They're going to understand. Customers know that our prices are going up. They're going to understand. I worry, Madison, how long that understanding is going to carry for. You know, there's inflationary impact, and I was talking earlier today, I just read an article this morning, supermarket inflation is about 11%. Restaurant inflation is sitting at about 8%. So in theory, comparatively, one could say, boy, the value might be greater at a restaurant today than at a supermarket, in a sense.
Right.
But it's not being realized at the rate that it should, and it's very concerning.
Well, I mean, so what, if that continues, John, what is the longer term impact? You know, it's interesting, our Kate Crater, who is our food critic here, and she said pre-pandemic, like it was just an explosion in the restaurant. It was called, I forget what she called, like the golden age of restaurants. And just people were trying new ideas and throwing things out. pandemic hits, it's obviously a very different environment. And as you say, we're coming off and you're feeling this tentativeness. If it persists, then what longer term do you see happening potentially?
I see flatter revenues long term.
Okay.
Because, it's innovation
'Cause eventually
that
consumers-
elevates us, right?
Yeah.
So when we're not having the innovation, when we're not having the depth of employee, the concentration of management, all these things take their effect on us. And it concerns me a little bit.
Yeah.
That
you do
boom
feel
town.
subdued.
Yes, but that boom town that you were talking about was a height of innovation.
Right.
New concepts, new chefs, new things were abound everywhere. Not so much now.
And it's just not the same experience, right? And this is such a privileged position to be in. I'm in New York. There's a great restaurant in every corner, but it doesn't feel the same. I feel like I'm paying more to be there for a longer amount of time, not necessarily get everything that I want, right?
Yeah.
Do you have a timeline for when I can get my great New York City restaurant vibes back?
It's funny, I was staying, and I won't say the brand, at a very high-end luxury hotel, about as high-end as you can get.
In New York?
This is a few weeks ago, yes.
Oh, okay.
And my breakfast room service came in a cardboard box. No plates.
You didn't like that.
And it's like I was in the middle of the pandemic, so I called up the general manager, and I said, when do you become a great hotel again? When does that happen? Is
Yeah.
it next month? Is it 6 months from now?
And we're being serious. Like,
I'm being
it's
dead
not-
serious.
yeah.
When do we make that commitment as an industry
Yeah.
to say no more? We have to get back to normal. I think that's a very powerful question, Madison. I wish I knew the answer to it. At some point, you're going to get disgusted, and you're going to go where you're taken care of, and you feel better. That's my concern.
Yeah, it does feel like I've been places too, and I'm like, wait, we're kind of out of the pandemic. Although we did talk to our team over at Hopkins earlier today, reminding that we're not completely out of it, but it does feel like people are still falling back on those ways. And it's like, well, wait a minute, we should kind of go back. Is it just because they're still looking to save costs or what?
I think it's just
Because some say they don't have the staff to do everything that they'd like to.
Think about somebody who owns a business for years. They believe their life is stable. This pandemic comes along. Now they're not stable. The instability is very fearsome to them.
Right.
Now we're coming out of the pandemic, but the fear isn't gone yet. And I think it takes time for that fear to sort of heal a little bit, Carol, and then to get to that point of decisive decisions again. And I think the economic environment worries us. I think the international environment worries us. I mean, there's a lot of things to be concerned about if you want to strategically look forward.
Right. John, what's great about you, as you say, you're talking to the mom and pops who own bars and restaurants. You're talking to the big, businesses out there that own multiple establishments. Do those conversations often involve talking about recession right now?
Yes.
They do, because it's fascinating, our market conversations where so many people are like, nah, we're just going to miss it, or it's going to be soft landing with no landing. You're hearing recession a lot.
I still hear the word recession quite a bit, and I hear it, of course.
High end, low end, mid end, what?
I hear it mid end.
Okay.
Mid end. Higher end, that I think that there's more of an economic concern with regard to inflationary impact, supply side impact, which is still a big deal.
Yeah.
A restaurant, if you get a certain hamburger style, your bun is sized for that, your plate is sized for that. Now you can't get that hamburger. You get a smaller hamburger. Doesn't fit on the bun, doesn't fit on the plate.
Right.
Here's a good one for you. You'll get a kick out of this. Those little ketchup packets. They were up at 40 cents for a while.
Yeah.
There was the shortage,
Yep.
too.
So now restaurants have to buy plastic cups, get ketchup, squirt it in a plastic cup, and now the plastic cup doesn't fit on the plate with the French fry. These little things become big deals when you're in the production business.
Yeah.
And these subtleties become nightmares.
I talked to the owner of a taco restaurant in Dallas, and he told me that the millennial obsession with Topo Chico was like ruining his business because it got so expensive because of the glass shortage, and he would just get wiped out of it all the time, but didn't want to raise the price too much. If you were giving that restaurant owner advice, what would you say?
It's funny. I did a rescue this season of a guy who's losing $2 a hamburger.
Yeah.
And he's proud of the fact that he's selling 100 hamburgers a day. I say, you'd be better off if you sold no hamburgers.
Yeah.
That's what I would tell him.
Yeah.
We're here to make money.
Well,
so we have to raise the prices. It needs to be reasonable. J.C. Penney, I love a quote that he said, if you don't take care of the customers, you lose the customers. If you don't take care of the business, you lose the business.
So I have to say, I wrote notes. I'm always shocked. Here, I'm going to read. On the generous pours that are done, like as I watch your show, and you have the technology that measures it in an instant, and the thousands of dollars that go out of a business, it seems like such an easy fix, right? So people are basically bartenders overpouring, right? No, I'm serious.
No, I know, yeah.
So I'm like, is it that easy a fix for most establishments, John, that if they just...
Completely.
Yeah.
Completely.
I'm always blown away
I'm
by it.
laughing
We have the
because
systems
of-
now.
yeah.
We have devices that we stick to the bottom of a liquor bottle when you buy it.
Oh, wow.
and it goes into the supply room.
I forget what it's called.
When you pick it up
Yeah.
and put it and bring it to the bar, on the map on your tablet, you see the bottle on its way to the bar. Now it's at the bar. Every time they pour it, I know exactly how much they're pouring from it. So all these systems are in place.
But it doesn't
Carol.
match up with the dollars that are
Bingo.
ultimately
Absolutely. The
collected.
consumption and the usage, the consumption and the sales don't match, right?
It's amazing.
You consumed 100 drinks, but you only sold 30.
Right. And the owners, when they hear the thousands of dollars that are going out, that sometimes add up to hundreds of, or $100,000 or whatever for the year. 30 seconds left, John. Unfortunately, season 8, what can we expect?
Oh, boy, this is a tough one. You know, last season, pandemic was a valid excuse.
Yeah.
This year, we were just talking about the lack of aggressiveness, of assertiveness. They need a kick in the butt.
Yeah.
I mean, customer traffic is up 20% or more. This is the time. Seize this.
Right, step up.
But they're not. So it's a very aggressive season, Carol, but I think I changed a lot of lives this year.
I love hearing that. It's really fun. It's small business. I talked earlier about the backbone of our country is these small businesses. So I'd love to kind of watch and keep an eye on it. John, thank you so much. Good luck.
Thank you. Good to see you again. Always good to be here.
Always good. Good luck with the season. John Taffer, host and executive producer of Bar Rescue, joining us in our interactive broker studio. What a delight. Be well. Travel well. You are listening and watching Bloomberg Radio. All right, let's get a check on World and National News. Nancy Lyons. She's in D.C. Hey, Nance.
Thanks, Carol. A Los Angeles judge has sentenced Harvey Weinstein to 16 years in prison after a jury convicted him of the 2013 rape and sexual assault of an Italian actress and model. The sentence comes on top of the more than 20 years the 70-year-old Weinstein has left to serve for a similar 2020 conviction in New York. The NTSB is out with its preliminary report on the cause of the toxic rail derailment in East Palestine, Ohio. It zeroes in on a wheel bearing that overheated and a sensor that failed to alert the crew. The release comes on the day that Transportation Secretary Pete Buttigieg.
This was declared over.
The most important thing is first of all, making sure that the residents here have what they need, something that we were working on from day one. The resilience, the resolve, and the decency of this community has been inspiring.
Buttigieg stressed that safety rules should ensure that such an accident never recur, and he urged other political figures to join that effort. In Washington, Irv Chapman, Bloomberg Radio.
On this, the eve of the one-year anniversary of Russia's invasion of Ukraine, the United Nations has passed a non-binding resolution that calls for Vladimir Putin to end hostilities and leave Ukraine. With President Biden back from his surprise trip to Ukraine, a new poll indicates he is gaining more support. Bloomberg's Joe Matthew has results of an NPR PBS Marist poll that was conducted last week.
Overall approval at 46%, 49% among registered voters, which is a more important metric that we follow, the highest in a year and up from a bottom of about 36% last July.
Bloomberg's Joe Matthew says support for former President Trump has fallen. 54% now feel the party would be better off with another name at the top of the ticket. Global news 24 hours a day. I'm Nancy Lyons. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:40 on Wall Street. I'm Charlie Pellet. We check the markets all day long at Bloomberg. Lots of earnings after the close of trading today. Among the names reporting, Carvana, that is the online used car dealer. It reported a much wider loss than Wall Street had expected for the fourth quarter. After hours, we've got shares of Carvana down now by roughly 1.2%. Beyond Meat surging. Beyond Meat reported sales that exceeded expectations. The company said it is making progress on efforts to bolster cash flow and lower inventory. After hours, we got Beyond Meat surging by roughly 12%. Regulators say Boeing has paused deliveries of its 787 Dreamliner as the plane maker conducts additional analysis on a fuselage component. Shares now down by about 1.6%. Tech led stock gains today. It was a jittery session before inflation data tomorrow that will help shape views on whether a soft landing is on the table. S&P up 21, a gain today of 0.5%. We had the Dow up 108, higher today by just about 0.3%. NASDAQ up 83, that was a gain of 0.7%. 10-year yield 3.88%, with the 2-year 4.70%. Gold down 0.2%, 18.22 the ounce. West Texas Intermediate crude up 2.3%, 75.65 a barrel. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
I'm going back to Cali. I don't think so. Going back to Cali, styling, profile.
All right, you gotta love Elon, who gave a lot of shade to California over the last few years, but guess what? He's now walking it all back, Maddie.
He's going back to Cali, as the song suggests. They're writing about it. Is Bloomberg News senior tech reporter Dana Hull on the phone with us from San Francisco. Dana, thank you so much for being here. What's up with this? We thought Elon hated California. What's changing?
Well, I think that this news, such as it is, has been a bit misrepresented. So Tesla's corporate headquarters, moved from California to Austin, Texas 2 years ago. Nothing has changed. The corporate headquarters is still in Austin. But what Musk and Governor Gavin Newsom announced yesterday is that Tesla's engineering headquarters will be in Palo Alto in the old HP building. And so it's like, okay, so there's the corporate headquarters in Austin, the engineering headquarters is in Silicon Valley. You know, this comes at a time when the Bay Area as a whole has been really slaughtered by tons of tech layoffs. So it's prime time to pick up engineering talent. And I think it's just Tesla kind of reminding everyone that they are still committed to California as a state, even though Musk himself has been sort of, poo-pooing the woke mind virus and complaining about San Francisco for the past couple of years. But, Tesla has always had a ton of employees here. Its flagship Fremont factory is still here. They've got 47,000 employees in California. And so it was just interesting. I mean, I see it kind of as a political story, because you have, Musk, who has been both, courting Texas, saying that he's going to vote for would probably vote for Ron DeSantis as president, and then appearing with Gavin Newsom, who's like a rising star in the Democratic Party. So it's very much playing both sides of the political aisle in the culture wars here.
Hey, so I wonder, Dana, how many things are going on here? I mean, did they get tax breaks to do this? I mean, he is a businessman. And I also think about, something we talked about with Bloomberg's Ashley Vance yesterday, who profiled a company making robots for metalworking. Stay with me for a moment. He noted how LA specifically is becoming quite a hub for manufacturing, and you talk about engineers. I mean, I do feel like there's a lot going on in that state specifically that would feed really well into what Elon needs to do.
Yeah, and it's about talent. And for a long time the idea was move to Austin where it's cheaper. But I mean, the last I checked, Austin is one of the most expensive cities in the U.S. now, and housing is a real problem there. And if you're a Silicon Valley engineer and you own a house or own a condo and have young kids in school, maybe you don't want to move to Texas. And there is quite a lot of talent here. A lot of people at Tesla come from Stanford. And so, I just think he's splitting the difference. And it's kind of like, yes, we're growing in Texas, but we're also growing in California. And that suits him very well politically, but also from a business perspective. I mean, California remains the state that has really paved the way for this whole electric vehicle wave. And the state is a leader in kind of transforming the energy grid as well. So, I mean, it makes sense to keep a very strong foothold here.
And going back to the political piece a little bit there, I think it sounds like from your reporting, Dana, that Musk's beef with California was the regulation piece. Has he just accepted that, or do you think that he's hoping for that to loosen a little bit?
Yeah, I mean, he has always complained about how hard it is to build in California because of our environmental regulations, which is kind of ironic. And, a reminder to all that the state of California sued Tesla for its anti-Black racism at the Fremont plant, and that suit is ongoing. But I think you're seeing Musk kind of do a little bit of kumbaya with Democrats. He thanked Joe Biden last week. Now he's appearing with Governor Newsom. And, as Tesla prepares for the next phase of its growth, they're going to need customers from across the political spectrum. And I think that this is a recognition of that. In terms of Carol's earlier question about the tax credits, we don't know. I mean, there was certainly not an announcement of any kind of tax break or scheme from the governor's office or from the company. And they're moving into something that was already built. I mean, they're basically occupying some old buildings. So I don't think it's not like the big tax breaks that Nevada got for building a new factory, for example.
And Dana, I have to think about some of the comparisons that we've seen between Musk and even a figure like Trump, given his support of DeSantis. In your reporting, are you hearing people characterize Elon a little bit more in that camp increasingly?
Well, I mean, Musk himself has said that he's likely to vote for DeSantis if DeSantis runs for president. So, and so, I mean, I think that, Musk's politics do not fit neatly into one camp or another, but I think, you can just look at his own record as to what he's tweeted about, what he thinks about politics, and, we'll see who he actually votes for and what the candidate field actually looks like.
It's interesting, Dana, I almost want to say, is this a kinder, gentler Elon? Or as you said, this is a company that's been around now for a while, but getting kind of ready for its almost next stage as an adult company.
Yeah, and next week in Austin, Tesla is having an investor day, and Musk is going to unveil his, master plan. Enormous amount to kind of clean up the electric grid. Customer base for that as well.
And we've been talking about some of the lower pricing on Teslas too, but kind of joking that you never know how long that's going to stick around because Elon can change his mind quite a bit. Dana, what's your take on that? Can consumers expect to see that lower cost vehicle platform moving forward?
Yeah, I mean, they're probably going to announce it. I would imagine that they will announce it next week. When it's actually built is anybody's guess. I mean, Elon has a long history of kind of announcing future products that then take several years to come to market. As we've seen with the semi-truck, we're still waiting for the next generation Roadster. We're still waiting for the Cybertruck. But sure, I mean, I think the company's goal all along has been to kind of move down market and to make more affordable cars as they scale up in volume.
Hey, Dana, as you continue to cover Elon, as you have for a long time here, and you've got great insight certainly on the company and on the individual, does it get any easier, or does it become more normal, or what am I crazy in even asking?
I mean, I think there's a lot to be said for institutional knowledge. Like, yeah. I mean, I feel like the benefit that I have is that I covered the company when they were small, and so I sort of understand their history and their evolution. The challenge is that they have their tentacles into so many different businesses now, like insurance and the wholesale energy market and housing and roofing and, robotics. They have like a lot of different, it's like a collection of different little startups, and sort of getting a bead on how those individual projects are developing is still pretty challenging. So if you work at Tesla, please call me, because I'm always up to chat and I'm happy to talk customers.
Definitely reach out to Dana. We always love your reporting and looking forward to that March 1st Investor Day and analysis on that and reporting on it as well. Dana Hull, thank you so much. Senior Technology Reporter at Bloomberg News, joining us on the phone from San Francisco. This is Bloomberg Business Week right here on Bloomberg Radio.
Your company news headlines on Bloomberg Radio.
From Bloomberg World headquarters, I'm Charlie Pellet. Lots of earnings after the bell. We're keeping an eye on Beyond Meat. That stock is surging. Investors certainly devouring Beyond Meat right now. It reported sales that exceeded expectations, and the company said it is making progress on efforts to bolster cash flow and lower inventory. Right now, we're looking at Beyond Meat. That stock is up by 14% after hours. Block Inc., that is the digital payments company formerly known as Square. It reported processing payments across the platform that fell short of analyst estimates, but after hours, we've got Block up by about 3%. Moderna kept its forecast for at least $5 billion in sales of its COVID-19 vaccine this year. And with more on the Moderna story, here's Bloomberg's Denise Pellegrini.
Charlie, the outlook for 2023 sales of the Spikevax shot, that's Moderna's only product, is based on existing orders. Wall Street analysts are estimating annual COVID vaccine sales of about $8 billion. Moderna says it additional sales in the U.S., Europe, Japan, and other markets this year are possible. The Cambridge, Massachusetts-based drug maker is losing its biggest COVID vaccine customer, though, as the U.S. government stops buying shots. That responsibility instead is moving to private companies and insurers. Meantime, Moderna is trying to shift attention to other programs that it does have in its pipeline, such as vaccines for cancer, RSV, and the flu. Charlie.
And that's Denise Pellegrini. Moderna down today by 6.7%. Wayfair shares plunged after the company reported a worse than expected loss. Wayfair, based in Boston, down today by 23%. Those are our company stories. This is Bloomberg.
This is Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
All right, we've got more Business Week to come, but up first, let's get a check on the latest world and national news with Nancy Lyons in the Bloomberg 99.1 newsroom in D.C. Hey, Nancy.
Thanks, Madison. Hollywood producer Harvey Weinstein has received a sentence of 16 years in prison for sexually assaulting an Italian actress and model. The judge issued the sentence after rejecting a motion by Weinstein's attorneys for a new trial. Today's sentence is on top of the more than 20 years he received for a similar conviction in New York. Singer R. Kelly was sentenced in Chicago federal court today to 20 years in prison for child pornography and enticement of minors. This sentence only adds a year to his prison time, as Kelly will reportedly serve 19 years concurrently with his New York prison sentence. Alec Murdaugh, the prominent South Carolina attorney on trial for murdering his wife and son, has been testifying in his own defense today. He says he did not kill them, but he did admit he lied when he told authorities he was not at their dog kennels just minutes before the shootings, despite being heard there on a video with his son. Jim Griffin is his attorney.
Alec, why did you lie to Agent Owen, Agent Croft, and Deputy Rutland about the last time you saw Maggie and Paul?
As my addiction evolved over time, I would get in these situations or circumstances where I would get paranoid.
Murdaugh faces 30 years if convicted. The National Transportation Safety Board is out with a preliminary report on the cause of a toxic train derailment in East Palestine, Ohio. Republican Congressman Bill Johnson serves that district.
All we know right now is the suspect is a failed bearing housing unit on an axle. Bearings fail for various reasons, but they are digging in deep to the sensors that alerted the train crew, the engineers, that there was a problem.
Congressman Johnson tells Bloomberg they'll keep testing the air and water until local residents feel satisfied. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Back to you, Madison and Carol.
Thank you so much, Nancy. Well, Bloomberg Business Week, we are brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds. Even if your small business only had minor setbacks during the pandemic, you could still qualify for a payroll tax refund. Provide the tax experts at Innovation Refunds with some basic information and then let them calculate the amount you are eligible for. If you want to learn more, just head to getrefunds.com. All right, you are watching Bloomberg Business Week. Carol Massar and Madison Mills getting ready to wrap up the day. Hey, one other story. Suzanne Woolley has, just been unfolding some great stuff for us. And this goes back to, again, Fidelity coming out with some data. Yeah. And this story is among our most read. It talks about the 401k Millionaires Club.
Yep, Fidelity Investments had just 299,000 seven-figure workplace retirement accounts at the end of 2022. The big headline here, decline in $1 million plus savings came as the average 401k lost 20% of its value last year, shrinking, number of 401k millionaires, I should say, shrinking by 32%. That's a lot, 32%?
Shrinking by a third, that's pretty substantial. And it was, I'm thinking about the retirement conversation we just had about a lot of Americans, aren't even involved in 401ks or haven't saved a lot, but that, and then apparently, it also adds into the story about some investors who are saying that the U.S. stock market crash is far from finished. So hold on to your hats, everybody. Hey, just quickly, the spy plane pilot, I'm sure you've seen the story. It's out there on social. U.S. Air Force pilot who glanced back as a camera focusing on the white airship that was floating below. We're talking about that Chinese balloon. So basically, he took a selfie with the Chinese balloon at 60,000 feet.
That has got to be a very expensive photo. I hope that the person who took this,
that's a good point,
prints it out, puts it on the wall. That's a really cool selfie. Like, he's in the airplane and you can see the balloon just floating around.
It's pretty amazing. We've been obsessed with that balloon, but to see this shot. Anyway, you can see it right now on YouTube